Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And in today's video, first of all, I apologize if I seem a little bit more prickly in this video, a little bit more excited and energetic, because today we're going to talk about a topic or a particular word that I cannot stand. It's a huge pet peeve when people mention this, and this argument and this topic keeps coming back over and over and over since I started this channel. And today we're going to debunk it, or hopefully I will try to debunk the NAV erosion myth. My opinion, I think it's a bunch of BS. It's a myth, and I'm going to explain why in this video. We're going to take a look at a few live examples together. So, as an income investor that has multiple social media channels and gets many comments and emails and whatever all day long, one of the most reoccurring, frankly, really amateurish and weird things that I get over and over again is that these high yield funds, or any high yield funds that give out a lot of income, have NAV erosion or capital erosion over time. So I think this makes no sense whatsoever, and I believe that if you don't understand what I'm about to tell you in this video, then most probably income investing is not for you. Let's get started. So first of all, let's actually figure out what the term erosion actually means. And of course, we're going to trusty Google here. The process of eroding or being eroded by wind, water, or other natural agents. So this is more in context to the natural world out there. You even have an example here, the destruction of tissue or tooth enamel. So, by physical or chemical reaction. Similar words, decomposition, decay, disintegration, waste. So in short, when something is eroding, it's disappearing and it cannot come back. You're not getting it back. It's disappearing. It's not like, if you look at pictures, I believe you'll see these pictures of, look at this rock over here. This is natural erosion. This is just a rock disappearing. It's not like someone is chiseling away the rock with a hammer and bringing it somewhere else. This is literally erosion. This is where something is literally disappearing from the face of the earth. So why do I feel that this is a myth when it comes to investing? A lot of people say with these high yield funds, and we're going to take a look at a few examples, but first I'm going to tell you my overall thought process, why I think it's a myth or it's a bunch of BS. And what most people fail to realize about these funds is that when they're giving out that high income every single month, that is not erosion because it's being given out to you. It's not disappearing. It's not going just anywhere. It's being given out to you in the form of a distribution, in the form of a dividend, right? So how could it be erosion if you're getting it every single month? Don't forget, everyone, when a high yield fund, whether it's a covered call fund, a leveraged fund, whatever it is that does covered calls, doesn't do covered calls, every month that it gives out that, let's say 10 cents a month, that 10 cents is coming from the NAV, right? It's not coming from, appearing out of nowhere. So the fund makes 10 cents in that month, let's say, and it's being given out to you. It's not eroding. How could it be eroding if it's actually being given out to you, right? So when someone says NAV erosion, it doesn't make any sense to me, because the NAV is consistently being given, a part of the NAV is consistently being given out to you in the form of income. What you do with that income, whether you buy more units, you would reinvest it in something else, whether you just keep it in cash and spend it to support your lifestyle, is completely up to you. But don't say it's eroding. Let me give you an example. Let's look at probably one of the most popular ones where people actually have this argument, QYLD. Okay, and I recently made a Facebook post about this. We'll go through it. So QYLD is a very high yield fund, which basically writes, first of all, it's a NASDAQ 100 index. They write at the money calls on the index on 100% of the portfolio, which means they're literally forfeiting all of the upside potential of the NASDAQ 100 index. And every month they're giving a really big distribution. You have them here. They've been doing this since 2014, and they actually added a really nice column here. And if you click here, you could actually see every month how much in percentage wise they're making with this really high premium. So they're giving out all the income, but every month they're making a really big premium. And the last one, let's look at the July one, 2%, a little over 2%, which means they're literally making 2% return that month. And what they do is they give out 1% of it, typically approximately. So you see that here. The QYLD distribution is 1%, so they cap it at 1%. You could check out my recent QYLD, RYLD, XYLD explain video if you want to know more about this. But basically, the fund made 2% gain because of that premium. 1% gets given out to you in the form of distribution, and the other half or the rest gets reinvested in the fund, increasing the NAV. So it makes 2%, that increases the NAV by 2%, and then it gives out a 1% of it as income, and the rest is reinvested. And you can actually see the monthly distributions throughout the life cycle here, throughout all the years. So why is QYLD a perfect example? Well, if we look at the post I did on QYLD in Facebook, people keep saying, and there's a million videos and YouTubers that talk crap about QYLD. They say that, you know, QYLD's NAV price or stock price just keeps eroding over time. So QYLD started, if we go to the max chart, at about $25. Right now it's at $17.52. I am filming this on August the 17th, so we're down 29%, 30 now, because it just went down a little bit more because the stock market is open, it's live. So you might be saying, look, this looks like a gradual erosion. It's not true. You cannot just look at the stock chart for anything that gives out income. So my argument is, you know, and I posted this on May the 7th, so keep in mind these are going to be related as of these prices I'm talking about in this post relating to May 7th, not right now. So on May the 7th, approximately, QYLD's price is $17.40. NAV erosion, well, because as we saw, QYLD started at $25, but it can't be erosion because since inception or since May 7th, as of May 7th, QYLD has given out $21.86 a share of income, right? If you add all the distributions throughout all the years, as of May here, QYLD has given out $21.86. So you can't just look at the stock chart and say 25 down to $17, my NAV is erosion. No, those monthly distributions are being given out to investors. How could it be erosion if decomposition, disappearing? It's being given out to you, so it is not erosion. So you have to factor in all those monthly distributions, and if you factor it in, you have to add whatever the stock price or the NAV is right now of QYLD, 1740, plus all those distributions that have been given out, 2186. So if QYLD would have never given out any of the income, instead they would have reinvested all the monthly distributions, the stock price as of May 7th, of course, would be $39.86. So the stock price of QYLD would have went from 25 to almost $40 if it didn't give out any of the income. This is why you have to remember, everyone, that the income that's being given out, that's being generated in these high yield funds, that gets added to the NAV, and when they declare and give out the distribution, that gets subtracted from the NAV, from the net asset value. You are getting it in cash, and you could do whatever you want with it. So it cannot, by default, be NAV erosion. If there would be an erosion with the fund, the performance, the total return, which is, if you look at any ETF, when you go to performance, this is total return. You see that QYLD since its creation, as of the end of July, is a positive return of 742. If you would see minus 742, then I could agree with you that your NAV is eroding because you have a negative total return. You cannot judge a fund or a fund's NAV just by looking at the stock chart, because with the stock chart, you do not see any of the dividends of the distributions. You only see the price return, the stock price return, not the total return. So if QYLD would have not given out any income, it would be almost at $40 now as of May 7th. And this is why, everyone, that when you look at QQQ instead of QYLD, and of course QQQ has a much higher total return than QYLD, I will admit that, because it's in black and white. But if you look at the stock chart, completely different. It always looks like it's going up. If you look at QQQ, or if you look at the SPX, which is the S&P 500, any index fund that is not designed for income, that doesn't give out any income or much income at all, of course they're going to have a better stock chart because it's not giving out any of the NAV. So it's growing over time. And for you to actually realize your total return, you have to sell it, right? So hopefully you understand what I'm talking about here. And another thing, and I'll show you with KLIP. So KLIP is a fairly new, very, very high yield fund that has almost 50% yield. They do at the money call options on an ETF called KWEB. I have a KLIP explained video and even do a Q&A with the fund manager you could check out. But I want to prove to you that the monthly distribution does not come out of nowhere. It actually comes out of the NAV itself. So if you look at, first of all, you could see KLIP, the stock chart does not look good, right? It started at about 24.50, something like that, and now it's at 18. You think, well, NAV erosion. But if you look at the return, the return is not negative. It's still positive since inception. Why is that? Because you have to count all the big monthly distributions it's given out. And if you look at the X dates, so the last one is July 27th, then June 26th, May 26th, 27, 28, June 28, May 26, April 26. It's something very interesting if you look at the stock chart. If you actually look at the X dates, you'll see that that is the day when the fund goes down significantly hard. So let's go do the exercise and go backwards in time. So 27, right? The 27th of July, then the 28th of June. If we look at the 27th of July, I could see it right here. Boom. There's the 27th of July. You see a steep, hopefully you could see it. Make it a bit bigger here. You could see a steep decline here, 26, boom, 27. Without even going back and memorizing, I know right away it's probably going to be the 28th, right? Let's see. Sorry, that's the next one. The 28th of June. So if you look at the 28th of June, bang, here it is. You see that it goes up, and then 20th of June, bang, goes down like a rock. Can you guess the May X dividend date? Probably going to be somewhere along here, right? The 30th or the 26th or something like that. Let's check it out in May. In May, it's the 26th, and it's also the 26th in April. So if we go to in May, on the 26th, 2 years 25, boom, 26, a big drop. If we look on April, here's the 24th, 25, boom, another big drop on the 26th, on the X dividend date. This is simply because on this day is when the dividend gets, or the distribution, the 86 cents, the 83 cents, the 83 cents kind of gets subtracted from the NAV because it's being paid out to you in income. So this is not something you could ever know by looking at the stock chart. This is why I always say looking at stock charts is dumb, guys, when you're dealing with a high yield fund. If you're dealing with a stock that gives out no income whatsoever, like an Amazon stock or a Tesla stock, then you can look at the chart all you want because it gives out no income. So that the stock is all you have. You could only make money with capital appreciation. You have to buy low to sell high to make money. It's the only way. So another high yield fund example is TSLY, the Yield Max. And same thing, if you look at this chart since inception, it started at 20, it's down to 1382, minus 32%. But if you actually look at the total return, the actual performance, which includes the income, you'll see that, since inception, it's in a big positive. It's positive. So, and that goes for any high yield fund. You have DFN also. People say NAV erosion with DFN. What are you talking about? It started at 13, approximately 13. Now it's at 582 today. But since inception, since its creation, it's given out $22.80 in income. If it would have never given out that income, if it would have stayed in the fund, the stock price of DFN would be 582 plus 2280, right? You understand what I'm trying to say here, guys? So when people say NAV erosion, it makes no sense to me. If you look at the stock chart and say NAV erosion, it makes no sense because the NAV is there's a big percentage of it being given out to you in the form of income. So how could it be erosion, decomposition, deterioration if it's actually being given out to you? And you could see that for any fund, even the Horizons Cash ETF, guys. What do you think all these little drops are? These are all the ex-dividend dates because the fund makes its interest. This is just cash savings account, guys, the easiest ETF in the world to understand. Here, it goes down because the interest is being paid out. It's being given out to you in the form of income. If it's not giving out any income, the stock chart would look very, very different. In fact, they have an ETF that's a cash savings ETF that does not give out any income. Instead of cash, it's called HSAVE. This does not give out any income, so it looks like this. The stock chart looks much, much better than cash, right? Because it's a gradual increase. Well, that's because it's not giving out any of that interest. It's being reinvested in the fund. So before I have a heart attack, before I have a stroke here, I hope I'm making sense and you understand that this is a very important concept you need to understand, everyone, when it comes to income investing. Most of, if not all of your returns are coming from the monthly distributions. That comes from the NAV. How could it be eroding if you're getting it? So my number one recommendation is always look at the total return, which counts the income, not the stock price return, which is just the stock charts. Okay, you cannot just look at the stock chart to judge a high yield income fund, because most of the return is being given out to you in income and cash with a monthly distribution. So this is a very important concept to understand if you're going to be an income investor, or you want to be an income investor. The accurate way to say it is maybe stock price decline. That's fine, but don't say NAV erosion. It makes no sense because you're getting the NAV every single month with those high distributions. Stock price, there's stock price return, then there's the total return. If a stock or a fund or ETF gives out any income, looking at the price return, the stock price return, is completely 100% useless, because total return is what counts. If you just look at the share price return, it doesn't include any of the dividends. You got to look at the total return. So NAV erosion, my opinion, it's a myth. If there would be erosion, NAV erosion, you would see a negative. By default, you have to see a negative return, not a positive return. All right, guys, so let me know what you think in the comment section below. Hopefully this makes a lot of sense. See you next time. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, PassiveIncomeInvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the ultimate DIY investing package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once, because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and PASSIV referral links below. So Questrade is the broker that I personally use, and PASSIV is the broker companion tool or companion or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades, and PASSIV, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of PASSIV is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members, where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram, where you could follow us, or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.